And for a deeper dive into the past week's volatility, let's cross to Stephen Wood, Chief Market Strategist with Russell Investments. He joins me from the NASDAQ market site in New York. Thank you for joining us.
Thank you.
So what's your take on all this market volatility and the factors behind it?
Well, in the United States, the economy still looks good. Earnings are going to look very good. I think that the factor that is really rolling markets is what's going to happen with Federal Reserve policy. So in a world of good fundamentals, coming into 2017, valuations or how expensive stocks were in the U.S. got quite high, and it got even more expensive in 2017. So if the Federal Reserve is likely to continue raising rates, and we think that they will, probably 3, maybe even 4 times in 2018, that changes how lofty valuations could have gotten in the U.S. So over the last couple of days, it's been very compact, but the market has reassessed the interest rate environment and the valuation environment of U.S. equities, even though the economy and a lot of the fundamentals still continue to be doing well.
So do you think that investors have gotten somewhat complacent, especially having enjoyed such little volatility over the last few years?
Oh, very much so. Investors have gotten extremely spoiled, to use your word, but they're certainly complacent, would be an expectation. Volatility has been very, very low, and in the United States has been even lower yet. So stocks have been moving up rather dramatically since 2009, but in the last year and a half plus, they've been moving up smoothly. And forget about a correction, which is fairly typical to have a few corrections within a given year. There hasn't even been that many 1% moves. So the low volatility has actually been kind of odd. And what we're seeing right now, for all of the last couple of days and how punctuated and staccato the volatility has been, it's something of a more normal environment. And we think going into 2018 and maybe even beyond, a more normal environment is something that global investors should expect.
And speaking of global investors, as they're watching this, they're also seeing, as we talk about interest rates going up, pushing up borrowing rates for companies and individuals. How are they viewing the U.S. market at the moment?
Well, I'm the chief strategist for Russell. I travel globally, Europe, Asia. I'll be in Tokyo in a couple of weeks. I'll be in Europe the week after next. So it really is a global market. And what we advise U.S. dollar-based clients as well as global clients is, first off, what's your currency? That might be more important than where you live, is what kind of money you spend. And then also, what do asset classes cost? And what we've been telling American USD investors is that the expensiveness or the valuations in the U.S. market are becoming a challenge. The economy looks okay, but with the Fed raising rates, those valuations are becoming more fragile. So they have an opportunity to look globally. So a USD-based investor looking multi-asset, active management in a diversified global portfolio, that makes a lot of sense. Elsewhere in the world, there are almost equally strong economic cycles, more accommodative central banks, and valuations are more attractive. So having a global perspective, being very nimble and active and multi-asset, I think addresses a lot of the issues in any given market.
Now, we've seen that U.S. markets have been pretty good about pricing in a lot of policy changes, as we saw with tax reform. But we know that we also have this big infrastructure policy that the Trump administration wants to push through, as well as immigration, some other things on their agenda. Given the volatility that we're already seeing, what would your advice be for investors at the moment?
Well, that is the situation where good news may be slightly bad news, because the tax policy will be stimulative to growth. There's going to be a repatriation of a lot of earnings ex-U.S. by U.S. companies. We've seen Apple and other companies announce that. That will add to stimulus in the U.S. Infrastructure will also add to stimulus. So what that means from our perspective is it's a positive, but what is the reaction function of the Federal Reserve? So the Federal Reserve for the last 2+ years has been very comfortable guiding to and raising rates, albeit modestly, into a mediocre environment. And now that we do have good economic data and inflation is becoming stable, perhaps even 2% or better very soon, will the Fed be even more comfortable raising rates when the environment goes from mediocre to good? So we always look at that through the lens of what will the Fed do. In other words, when the bond market is giving information, don't ignore it.
And a lot of people have been wondering about this balancing act of raising interest rates. We're seeing inflation likely to creep up, but also really trying to make sure that we don't enter recession territory. What's your take on the likelihood of that happening in the longer term?
Well, I think in the excellent point of near versus longer term. In the near term, we don't see a recession in the U.S. We do not have a recessionary expectation for 2018. That said, the yield curve is flattening, which means that short-term interest rates are moving up and they're getting close to longer-term rates. So a flat or inverted yield curve where short rates are higher than long rates is a classic indicator of a recession. So about a year's time from now, a flat yield curve is a very real expectation in the United States, which means that the odds of an economic slowdown, a recession, end of 2019 going into 2020, the probability of that becomes more material than it would have been, let's say, 6 months ago. So will the Fed be able to avoid a recession? It may not even be that the Fed chooses to avoid a recession, depending on what their assessment on tightness in labor markets, wages, and inflation is.
All right. Well, thank you so much for your insights. Stephen Wood there of Russell Investments.